Thank you very much, Nina, for that glowing introduction. Not at all deserved, I would say. I'm delighted to be here. That's the first thing I want to say. We have been joking, Ian and I and others, that it's a while since I have been here. I have been here before, and I'm always delighted to come here and speak. But it is a while since I've been here, and in the meantime I've actually addressed AIIA branches in other states around Australia. And I very much cherish those opportunities that I get to speak to such audiences, because in my experience you have been extremely interested, motivated in coming, and very experienced and knowledgeable yourselves. And I have always learned more from the exchange afterwards than I ever felt that I had given back in my own discourse. So this evening I'd like to speak a little bit about how Europe is navigating through the economic crisis. And I want to look at the year that has just passed, 2012, which has been a year of crises, plural, but also a year of progress. And I'd like to also then look at the year ahead, what we're still working on, and what are the issues. As a starting point, I think we should just reflect for an instant on the fact that the global financial crisis brought the financial and economic system of the world to the brink of disaster. It was the worst economic crisis since the 30s. And billions of euros, pounds, and dollars were spent all over the world in stimulating economies so that we did not all individually or collectively fall over a cliff. Now, the financial crisis also revealed for us in Europe a number of serious shortcomings in the design and governance of Europe's economic and monetary union. Existing structural imbalances were exacerbated, and in the absence of truly coordinated economic policies, tools designed to deal with the instabilities were found to be inadequate. Now, a year ago, the doomsayers were foreseeing the end of the Eurozone, questioning the resilience of its member economies and their commitment to reform. The situation in Greece fueled profound uncertainty. Italy and Spain were of mounting concern. Problems in Ireland and Portugal were also of concern. Financial market confidence was at a low. The despondent mood at the time was recently recalled by the President of the European Central Bank, Mario Draghi, in his recollection of what The Economist had to say in their annual publication, The World in 2012, which in late 2011 considered that Europe's capacity to assume greater responsibility and greater solidarity as, and I quote, utterly beyond reach. Now, looking back over the last year, this pessimistic outlook was revealed to be inaccurate in the light of the results and the ambitions of the EU member states, of the euro area, and of the Union as a whole. The concerted actions taken have contradicted the darkest predictions and helped to rebuild confidence upon which further reforms focused on creating jobs and growth can be based. We have, in football terminology, turned the corner, as coaches are inclined to say. But I would suggest that it's like what you say at half time in a match. There's still a difficult second half or a second, third and fourth quarter to be played, and it will be tough. But nonetheless, 2013, this year, has started on a more positive note, and we must maintain the momentum that we have built up since the middle of last year. It's clear that we have a debt crisis to deal with. The deterioration in member states' public finances as a result of the economic crisis and the build-up of unsustainable public debt in the EU has necessitated a comprehensive response, reinforcing the existing mechanisms for encouraging fiscal discipline. Europe's fiscal rules were significantly strengthened in January this year when the treaty, what we call the Treaty on Stability, Coordination and Governance, which also goes by the title of the Fiscal Compact, which was signed in March of last year, it entered into force last month. Now, this legally binding agreement establishes a balanced budget rule which must be incorporated into member states' national laws, and along with reinforced surveillance, it obliges euro area member states and other member states, if they wish, to ensure convergence towards a country-specific medium-term fiscal objective. This builds on a package of new EU laws which were adopted at the end of 2011, which also imposed greater fiscal discipline on the 27 member states. Additional specific rules were put in place for the euro area member states, and most notably financial sanctions where action is not taken following recommendations. Here there has been a very, very important change. Such sanctions can be applied to a member state if they are persistently not following the recommendations proposed by the European Commission but adopted by the Council, that's to say adopted by the member states. Those sanctions or those measures can be applied to a member state unless there is a majority of member states that vote against it. This is actually a reversal of the normal legislative process. In the past, we've also had some sanction capacity for proposals from the European Commission, but it has needed a majority vote of the member states in favour so that the sanction or the measure could be applied. But in the course of 2011, member states in the Council agreed to reverse that voting mechanism. Now, at one level that's a technical thing, but at another level you can see that it really represents a sea change of attitude to the question. And the sea change of attitude is the following one. In the European Union, economic policy is an area of national sovereignty. But member states have agreed that they should conduct their economic policies in such a way that they are going along in the same direction and that there are not problems created through economic policy. But what we have seen has been that the question of member states saying around the EU table that, look, it's my national affair, the economic policy, so I know that you take an interest, you, the European Commission, or you, the European Central Bank, or whoever, I know you take an interest in this, but it's still my national domain. And I would rather that you don't take too much of an interest. What has happened has been that the crisis has demonstrated that it's too much of a luxury to just stop at that point and to say economic policy is my affair. Particularly among countries of the euro area, it is clear that everybody's economic policy in their own corner has a direct implication for our common currency. And so member states have, I think, had this realization that more needs to be done in a more coordinated and collective manner in terms of economic policy. And hence they have agreed that that voting mechanism, which needed a majority of member states in favour of applying a sanction, that should be reversed. so that nobody gets the feeling that what they're doing in their own corner is only their own affair. And this is something which is very empowering, because it means not only that others are looking at what you're doing in your area, but you have a responsibility also to be checking what others are doing in their area. Now, I departed a little bit from my prepared text, and I'll just find where I was. The reversal of the voting mechanism. Yes. So, helped by these commitments, public finances in the EU are gradually improving. In 2009 and 2010, the average fiscal deficit in the euro area was above 6% of GDP. For 2013, it is forecast to be at less than 3% of GDP. Public debt, presently averaging at above, at around 85–90% of GDP in the EU, this presents a more intractable problem, justifying the need for consistent fiscal consolidation. Hand in hand with the debt crisis, we are dealing with a competitiveness crisis as well. And to regain competitiveness and in turn boost job creation and lift productivity, the Member States have engaged upon a wide range of structural reforms, introducing greater flexibility into the labour market, addressing demographic issues through rising pension ages, striking a better balance between taxation and social benefits, and making their economies more business friendly. These measures are accompanied by targeted investment in human and physical capital, youth training and apprenticeships, innovation, the digital economy, and green technology. These reforms are working. Important improvements are taking place in competitiveness. For countries engaged in adjustment programs, unit labour costs have fallen towards or below the pre-crisis levels, which, combined with the impacts of deleveraging and improving trade balances, have translated sustained current account deficits into surpluses in the most recent quarterly data. Ireland's relative unit labour costs have fallen by almost 20% since the height of the crisis. And exports are recovering and growth is forecast this year. In Portugal, long and short-term interest rates on debt have fallen significantly. Greece is making inroads into its reform undertakings, enabling the release of funding for the second programme of assistance from the EU. In Spain, exports have expanded by almost 20% in real terms between 2009 and 2011, and liquidity constraints on its banking sector are easing. It helps greatly the economic resilience of the European Union that we have a large single market of over 500 million consumers, where goods and people and capital services can move freely between the different countries. EU regulation, which is much maligned in the mythology of the EU, nonetheless, EU regulation has freed up the European marketplace, replacing 27 different and often more complicated sets of national regulations. It has also harmonized standards across countries, reducing costs to consumers. However, the single market remains incomplete. There is more that we could do, and there are renewed efforts at completing the internal market. Last year's adoption of the European Unitary Patent, which was a discussion that had gone on for quite a number of years, and the presentation in October of new priority actions in the area of transport and energy networks, citizens and business mobility, the digital economy, freeing that up. These are measures designed to go further in reducing the practical economic barriers within the single market. One of the implications of having a huge single market is that it encourages EU companies to be global in their search for competitive inputs, and it forces EU suppliers to sharpen up their products. You should know that 2/3 of what Europe exports involves imported components. And externally, Europe remains the world's largest trader, foreign direct investor, and recipient of foreign direct investment. Trade has been described as an essential lever in the EU strategy to boost jobs and growth. This is reflected by about 30 million jobs in the EU being dependent on sales to the rest of the world. While seeking to maintain the centrality of the multilateral trading system, the EU has also pursued closer bilateral relationships, concluding a free trade agreement with Singapore at the end of last year. We are close to an agreement, we hope, with Canada, and we hope to shortly start negotiations with Japan and hopefully also with the United States. I think I heard today some of the other colleagues mention that President Obama has referred to this actually in today's State of the Union speech as one of the things on his to-do list to negotiate a deep and comprehensive economic partnership agreement with the European Union. Fulfilling this trade agenda could boost EU GDP by more than 2% or 250 billion euro and support an increase of more than 2 million jobs related to trade across the EU. So all of these measures taken together demonstrate that across Europe the challenge of competitiveness is being faced up to. We also have a crisis of what I would call the system of the common currency, of the euro. As we know, the system of the common currency was, it has had certain weaknesses revealed through the pressures of the economic crisis. We don't have a transfer union, what economists call a transfer union, in the EU, meaning that there is not a system for automatic transfers of funds from countries or regions in deficit from the centre, like you have in Australia through the federal system or in other countries. And we don't have a single economic policy or a single economic governance for the euro area. And we have suffered in the crisis through market uncertainty as to what the role and the actions of the European Central Bank would be. The stability of the euro, nonetheless, has been underpinned over recent months by measures enacted last year by the central bank, which, in the words of its president Mario Draghi, where he says that he was ready to do anything, ready to do whatever it takes to safeguard the euro system. These words themselves sent an important message of confidence. It engaged in monetary transactions, enabling unlimited intervention in the secondary sovereign debt market, which entailed conditionality for countries having an adjustment program. And it helped to eliminate some of the fears affecting the euro area. So the actions of the central bank have been very important in calming the markets down, starting around the period of August, September of last year. In September, the European Commission outlined a proposal to establish a single banking supervisory mechanism, part of what we call a banking union, a single banking supervisory mechanism for the euro area. And this will give a greater role to the European Central Bank. This is a key step in the creation of the banking union, and it is part of an ongoing debate about deeper integration, and I will say more about that in a few moments. But we are not a transfer union, as I said. Nonetheless, the euro area was also notably strengthened last year with the launch in October of the now permanent European Stability Mechanism, the cornerstone of the so-called European Firewall funds. This comprises a capital base of 700 billion euro, rising to €1 trillion if we factor in funds coming from pre-existing European Financial Stability Facility. And its introduction has helped to break the vicious circle between banks and sovereign debts. Before the crisis, we didn't have any mechanism in the euro area for dealing with these sorts of problems. The Greek situation caused leaders to put a pot of money on the table to help Greece out in April, May 2010. 3 weeks later, leaders agreed that such a pot of money, we should have it not just for Greece, but we should have something for other member states should they need it as a temporary measure. And some months later again, it was agreed that that fund of money as a temporary thing should be replaced by the one I've just mentioned, the European Stability Mechanism, as a permanent tool. This illustrates some of the political resilience of the European Union, the ability to find a solution in the immediacy of the crisis, but to immediately refine that solution, not once, but twice. And this is something which is important in your considerations of the European Union, that this way we have of working together gives us a very strong political resilience, an ability to find solutions that enable us to get through a crisis and to move on. Now, moving on to this year and what we're currently doing, well, on the one hand, I think we can be heartened by some recent assessments of several European leaders. Commission President Barroso, who still remembers with great fondness and professional respect his visit to Australia 2 years ago. President Barroso described last year as having ended on a positive note for the euro area and consequently for the EU as a whole, saying that there is no longer a perception of the risk that the euro area will fall apart. The Vice President of the European Commission, our Commissioner for Economic and Monetary Affairs, foresees that this year shall be less turbulent and a much more boring one than last year. And the President of the Central Bank recalls last year as a year of challenges, but also a year of surprises and new beginnings. Now, as part of the new beginnings, there is a political debate about what we need still to do. We're in a better place this time this year than we were this time last year. But the EU economy remains weak, and unemployment is at historic highs in the Eurozone. Even if it does range from 4.3% in Austria to an unacceptably high 26.1% in Spain. And youth unemployment is an even more dramatic concern. But nonetheless, a gradual return to economic growth in the EU is forecast by the European Commission for this year of growth of 0.4%, and next year projected to rise to 1.6%. These are not great figures, but they are figures that confirm that yes, we are turning the corner. And even though we do have to go out and battle in the second half or the second, third and fourth quarter, things are going in the right direction for us. But the political debate rolls on. These measures that we've taken, that I've described, they have created a momentum for further integration. In June last year, President Van Rompuy presented an initial report to EU leaders to help stimulate a debate on what we call moving towards a genuine economic and monetary union. This is a recognition that the euro area needs even stronger mechanisms to ensure sound national policies so that EU member states can reap the full benefits of the economic and monetary union, the EMU as we call it. The final report was released in early December alongside a blueprint adopted by the European Commission providing a background to a roadmap. Now, this was subsequently agreed to by European leaders, and what is set out here is a political debate on where we need to go further in having, for example, the banking union. Having a single supervisory mechanism for European banks is an amazing development in Europe. But it needs to be accompanied by a system for common resolution of bank failures. You can't have one without the other. We need to work on what we call a fiscal union, where strengthened solidarity mechanisms and central enforcement mechanisms are needed to avoid unsustainable government deficits. And we need to work on an economic union to improve the competitiveness of the euro area as a whole. And all of this needs to be underpinned by a deeper political union to ensure that all these measures are themselves able to be sustained through increased democratic legitimacy and accountability. Now, I've mentioned that we're on the way with these measures. We have taken decisions on the single supervisory mechanism and so on. We're developing a proposal for a single resolution mechanism, a European-wide framework limiting the cost of bank failures for taxpayers. In terms of economic governance, we started back in 2011 with a new way of doing economic policy coordination, which we call the European semester. This is a process whereby member states they inform the EU, the European Commission, the Central Bank, and other member states. They inform us about their economic and fiscal policy ideas. And these ideas are subject to a very intensive peer scrutiny, both by EU institutions such as the Commission and the Central Bank, and other member states. This peer review process results in the Commission making recommendations, proposals on measures to the member states. And these proposals are themselves adopted by the member states in the Council. This mechanism itself is the start of a process of already closer economic policy coordination. But it will lead to further ideas on how we can do even better on that, how we can have even closer economic policy convergence. And President Van Rompuy is due to present follow-up proposals in this direction to the European leaders in June this year, amongst which will be the creation of what he calls a convergence and competitiveness instrument, requiring euro area member states, and also it is open to other non-euro member states, requiring them to enter into contractual arrangements with the EU institutions for the implementation of structural reforms to enhance competitiveness and growth, in return for European financial support for their implementation. Other policy actions are foreseen over the medium and longer term, which will entail perhaps modifications of the current treaties and new competences for the EU. This requires a broad debate as we prepare to move ahead and strengthen cooperation and integration in the financial, fiscal, economic and also the political field. But as I've said, this political debate is already engaged. If I had been given this presentation this time last week, I would now be drawing to a conclusion. But sadly, I'm going to go on for another 5 minutes because I want to update you on the results of the European Council meeting of last week. The European Council is the body which brings together the Prime Ministers, the heads of government and the heads of state of the European Union, and it is presided over by President Van Rompuy. But last week the European Council agreed on the EU budget for the next financial period, 2014 to 2020. Reaching agreement was not easy because the leaders had to reconcile many different considerations, pulling in different directions. Actually, this is perfectly normal for such negotiations, and we've had them every 7 years. However, this time, the economic crisis added extra spice to the negotiations, and I would suggest that it did so in at least 2 ways. Firstly, since member states have been hugely cutting their own national budgets, there was pressure for the EU budget also not to be immune from this. There was pressure for the EU budget to come out leaner than before. Secondly, since Europe must continue to invest in growth and jobs to successfully come through the crisis, then money had to be safeguarded for these investments. The net result is a budget with a cut of 3.7% on the previous budget for the period 2007 to 2013. And this is the first time in this cycle of EU budgets that there has been a cut from one period to another. Nonetheless, within that budget, there are important increases for growth and job investments. The heading that we have for what we call competitiveness for growth and jobs has been increased by 34%. Research and innovation, our program there, which is called Horizon 2020, has been increased by 29% to 71 billion euro. This is the previous program at around 54 billion euro. This was already the largest public investment, innovation, research and development program in the world. And it is a program which is open to research institutions and researchers from all over the world in cooperation with European researchers. And we encourage Australia very much to participate in that. And the Australian participation is already very good, but it could be improved. In addition, we have a new youth employment initiative of €6 billion. So notwithstanding the cut in the overall budget, these measures have been not only safeguarded but prioritised. And at the same time, Europe's commitment to the outside world is not reduced. Our budget for what we call European Development Fund and for what we call Global Europe, these figures are slightly increased on the previous period. As next steps, the budget will be voted on in the European Parliament, but I think we would all describe it as a tough budget for a tough period, but also a budget that invests in the future. Now I can come back to where I would have been had we been having this speech last week. Let me conclude. Europe is very resilient. It continues to adapt and to renew itself. We have a proven history of growing stronger in difficult times. Challenges and crises have motivated us to improve and to carry on. There has been the tendency of markets and some commentators to belittle the far-reaching measures already taken and to underestimate the complexity of moving forward 27 democracies, soon to be 28 democracies, with the accession of Croatia in July this year. However, I would ask Australian audiences to just reflect for a moment as to what this level of engagement would mean for Australia, were it part of such a regional integration project with its neighbours. Even on a national scale, we can already observe the challenges faced within the Commonwealth as Australian state and territory ministers attempt to nut out nationwide solutions together. But imagine that at the international level, because that is what we do on a daily basis in the European Union, where every month the Minister for everything under the sun, industry, trade, environment, agriculture, foreign affairs, whatever, ministers come to Brussels to try and find European-wide solutions for the problems that we face. And when we don't reach agreement this month, that's fine. We may feel better, we may feel that we're stronger in defending our national position. But the problem doesn't go away. And we know we have to come back next month. So there is an underlying momentum for finding solutions. And this is what I meant by the political resilience. The existential crisis for the euro has abated. And this paves the way for regaining market confidence and progress in the reforms that are already underway and currently being planned, staying the course, as I call it in the title of this presentation. None of this is easy, but all of it is necessary. And we do have the political vision and the political resilience to achieve it. Thank you very much for your attention.